From early 2020 through late 2024, the positive link that exists between the Canadian dollar and crude oil prices was mostly intact. Now, this connection makes a lot of sense. Oil is Canada's top export to the US, driving about a third of total exports and valued at $151 billion in 2024. That's nearly 60% of all US oil imports and almost 80% of Canada's total production. But something unexpected has happened in 2025. The long-standing oil versus loonie correlation broke down. Now, this shift could be tied to the heightened trade tensions and new tariff policies, making those issues more important for the markets than oil prices. Now, from mid-January to mid-April, oil lost over 30% of its value, yet the loonie gained more than 5% over the same stretch. And more recently, since August 1st, the Canadian dollar is up another 1%, while crude oil has dropped by more than 5%. Why this disconnect? Well, much of the loonie's most recent strength is tied to domestic developments. Specifically, weak U.S. job growth is heightened by the August 1st jobs report. Weaker employment numbers could prompt the Federal Reserve to pursue easier monetary policy than we once anticipated, which can further lift the loonie versus the dollar. Now, looking ahead, the next market-moving data point is the U.S. CPI report due August 12th. If inflation comes in low, it could clear the path for an even more dovish Fed, potentially strengthening the loonie and putting further pressure on the U.S. dollar. In short, while oil still matters, policy and global trade factors now play a bigger role in driving the Canadian currency. But the market may suspect that normal correlations could soon return if trade policy becomes more settled. Now, CME Group offers 3 different size currency contracts, the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believes the Canadian dollar is heading higher from here, they could express that by buying the September micro Canadian dollar futures contract at 0.7286 and target a move back to the July highs of 0.7400. Now, a stop for this trade will be placed below at 0.7210. This trade can make $114 if the target is reached and risk $76 if you stop at your level. Now, if a trader believes the Canadian dollar is heading lower from here, they could sell the September micro Canadian dollar futures contract at 0.7286 and target a move back to the February highs of 0.7140. Now, a stop for this trade could be placed above at 0.7350. This trade can make $146 if the target is reached and risks $64 if you're stopped out of your level.